Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, welcome to today's Explainer. Today, we're opening up the 10K and recent financial filings of Okta, which, as you probably know, is a dominant player in the cybersecurity space. We're looking past the flashy earnings headlines to really break down their strategic shift toward artificial intelligence and, more importantly, evaluate whether their evolving business model actually justifies their valuation. We've got a lot of hard data to parse through today, so let's get right into the numbers.
Okay, let's dive into this. We've got a 5-part roadmap for today's Explainer. First, we'll establish their baseline with the identity standard. Then we'll open up the hood on their financial growth engine. Third, we'll explore their aggressive pivot into securing the AI future. Fourth, we'll analyze a very deliberate strategic partnership shift they're executing. And finally, we'll weigh their outlook against the broader competitive landscape.
Let's start right at the foundation with Section 1, the identity standard. Because look, before we can project where Okta is going, we absolutely have to establish their baseline as a leading independent identity provider.
Okta essentially refers to itself as the world's identity company. Their core operational function, securing both human and machine identity so users can safely interact with technology. Whether it's an employee authenticating into a corporate email or you logging into a banking portal, Okta serves as that foundational security layer. They authorize access for literally thousands of organizations all over the world.
And they are operating at a massive enterprise scale. Okta recently surpassed $3 billion in annual contract value. $3 billion. That metric really highlights the immense scale and, frankly, the stickiness of their subscription business. They aren't just selling one-off software. They are securing highly predictable recurring revenues by integrating themselves so deeply into the operational security architecture of businesses globally that they become practically indispensable.
So how exactly did they reach a $3 billion ACV? That brings us to Section 2, Financial Growth Engine. Let's look at the exact financial mechanics driving this whole operation.
Now, what's really interesting about this historical Morningstar data is how clear the trajectory is. Revenue has steadily climbed from $1.3 billion in fiscal 2022 to nearly $3 billion projected for fiscal 2026. But as analysts, what we really care about is margin, right? And gross margins expanded from 69.5% to a robust 77.3%. The real fundamental shift, however, is the cash generation. They swung from a $53 million cash burn just a few years ago to generating over $1 billion in free cash flow projected for fiscal 2026. Guys, this is a highly optimized financial engine.
This cash and revenue expansion is fueled by a textbook land and expand strategy. Sure, they have over 20,000 total customers, but the real story, it's in the larger cohorts. They now have over 5,100 customers, spending more than $100,000 a year, and 545 customers, spending over $1 million annually. This shows massive strength in large enterprise accounts, which now drive a dominant 85% of their total annual contract value. They land a client, and over time, they just deployed more identity solutions to capture a much larger share of wallet.
But what happens to this model when the very nature of identity completely changes? That brings us to Section 3, Securing the AI Future. This marks a massive disruption in their traditional model as they pivot aggressively into the next frontier of cybersecurity.
The identity market is undergoing a really rapid shift. Historically, identity meant securing a human typing in a password. But today, artificial intelligence is acting as the primary catalyst for Okta's new product development. We are entering an era of non-human identities. Think autonomous AI agents operating on behalf of users. These agents require the exact same strict security, authentication, and governance as your human employees.
Okta's CEO, Todd McKinnon, summarized this strategic shift recently saying, "To get AI right, you have to get identity right." And honestly, the logic is totally sound. If an autonomous AI agent is out there drafting contracts or accessing sensitive financial data, that agent poses a massive security vulnerability if its identity and permissions aren't locked down tight. Managing these non-human AI agents requires rigorous, flawless identity checks.
Let's move along and see how this builds into their actual product architecture. Okta has engineered a brand new product lineup specifically to mitigate these AI-driven security risks from day one. Step 1 is Auth0 for AI agents, which secures application-level authentication, so developers can actually build secure AI.
Step 2 is Okta for AI agents, providing the governance, lifecycle management, and strict access controls for these tools. And Step 3 is centralized oversight. This creates a secure vault for credentials, allowing these AI agents to safely connect to third-party software without ever exposing raw passwords.
And these aren't just R&D concepts or vaporware. There is verifiable enterprise adoption happening right now. Recent deployment examples include a Fortune 500 tech company standardizing its entire AI strategy on Okta, a regional financial services firm using them to secure autonomous agents with strict human-in-the-loop safeguards, and a global tech company governing a rapid, widespread deployment of AI agents across their workforce. The demand for securing non-human identities is materializing as we speak.
Now, implementing these complex solutions at scale requires significant operational bandwidth. That leads us to our fourth section, the strategic partner shift. Here, we're looking at a very deliberate operational change Okta is making that is currently acting as a speed bump for their total revenue growth, but for a very specific reason. And this brilliantly illustrates the strategic trade-off management is actively making. On one side, you have short-term friction. Okta expects a 1% headwind to their total revenue growth because they are deliberately offloading their professional services business. But on the flip side is the long-term gain. By letting global system integrators and partners handle that lower-margin, highly manual implementation work, Okta can focus strictly on accelerating their high-margin software subscription growth. They are absorbing a small hit to the top line today to build a vastly more profitable, scalable business tomorrow.
The proof that this partner shift is actually taking hold is incredibly clear in the data. In their fourth quarter, channel partners were involved in 18 of Okta's top 20 deals. When partners are involved, Okta explicitly noted that it leads to larger average deal sizes and improved overall close rates. On top of that, their AWS Marketplace channel generated roughly $750 million in fiscal 26. That is a 45% surge in momentum. Shifting the implementation burden to partners is actively helping them close larger, much more lucrative contracts.
Which brings us to our final section, outlook and competitive landscape. With this AI pivot and the partner shift well underway, how does Okta's future guidance actually stack up against the broader market competition?
It's absolutely vital to remember that Okta does not exist in a vacuum. As they note in their own filings, they operate in a rapidly evolving market and face intense competition. Their primary competitor is a legacy infrastructure provider with incredibly deep pockets, Microsoft. Competing against an established titan with nearly unlimited resources means Okta has to constantly innovate and execute flawlessly just to maintain their footing.
When we objectively look at the competitive data, a pretty nuanced picture emerges. According to CSI market data for Q1 2026, while Okta grew revenues by a solid 11.19%, the average revenue growth of their competitor group was actually much higher at 18.84%. Similarly, their net margin trailed the peer average, leading to an estimated market share loss of about 0.46% in that specific period compared to hypergrowth peers in the software segment. So, the data tells us that while Okta is definitely growing steadily, they are navigating a highly competitive landscape where hypergrowth is the actual benchmark.
So the crucial point here is how Okta's management is guiding for the year ahead, fiscal 2027. They're projecting total revenue of up to $3.19 billion. That represents a moderating 9% growth rate, with subscription revenues growing slightly faster at 10%. This reflects that 1% headwind from the partnership shift we just talked about. But crucially, they remain highly profitable, guiding to a 25 to 26% operating margin. And they're backing this all up with a fortress-like balance sheet featuring over $2.5 billion in cash, which has allowed the board to authorize a massive $1 billion stock repurchase program.
This brings us to the ultimate question as analysts. Does Okta's $2.5 billion cash position and their first-mover advantage in securing AI agents outweigh the friction of their moderating single-digit growth? Management is clearly sacrificing short-term revenue to capture the future AI identity market. The models are pointing one way, but this operational pivot definitely introduces some real risk. So which side are you on? Do your own homework, keep a close eye on their upcoming earnings reports, and thanks for joining me on this explainer.